The nature of where their stores are, they probably rent a vast amount of their store fronts. And so that's cash they have to pay out, where Walmart does not. So obviously completely different businesses retail wise, but it's what popped into my head.
So if I were to open your closet, I wouldn't see some Lululemon right next to your, no?
No. I am fashion challenged.
I love this podcast because it crushes your dreams of getting rich quick.
They actually got me into reading stats for anything.
You're tuned in to the Investing for Beginners podcast.
Led by Andrew Sather and Dave Ahern.
Step-by-step premium investing guidance for beginners.
Your path to financial freedom starts now.
All right, folks, welcome to Investing for Beginners podcast. Today, we're going to continue with another episode of Financials Demystified. Woohoo! I know you're excited. Today, we're going to talk about some more accounting stuff, and we're going to make it fun and exciting, I promise. Today, we're going to continue our discussion on the balance sheet. And last time, we talked about current assets. This time, we're going to talk about long-term assets, which are all part of total assets. So with that, let's dive in and do a quickie on what are long-term assets.
Let's do it. I like to keep things simple, try to keep things relatable to the real world. So for me, when I learned about long-term assets, thinking about somebody's house or office buildings or Target and their stores, Walmart and their stores, Home Depot and their stores, those things helped me conceptualize what a long-term asset is. And if you think about what it is when we talk about, what's a piece of real estate or what's a building, it's something that's going to provide value to the business over multi-year periods. Contrast that to something like a current asset, short-term asset. If I have inventory and I'm Walmart and I'm selling sporting goods, that inventory is an asset that's only giving you that one-time benefit when it is sold and it's converted to cash. These long-term assets are providing cash flow over multi-years. So that's one important distinction. Another is just in the accounting itself. When a business is investing in the long term, if they're securing a lease for a building over 30 years or whatever the lease term is, they are also needing to account for that on the balance sheet in that section. And the way it links to the cash flow statement is also different. So if you were, again, to use inventory as the counter example, if you were spending or investing as a business to buy some inventory, that would be on the operations side of the cash flow statement. Any long-term assets, in particular, I'm thinking of property, plant, and equipment. Maybe we can start with that one. That one seems to be an easier one. But if you're talking about property, plant, and equipment, then that needs to be in an investing section of the cash flow statement. So hopefully I didn't throw too many terms in there, but that's how you need to account for it and think about it. In your mind, what does it tell you? Like, what property, plant, equipment is it? Are you even looking at it? Like, how does it play a role in looking at investments just in general?
Oh yeah, it plays a huge role in when you look at the balance sheet. Probably the first three things that I look at when I look at the balance sheet is I look at the total current assets, I look at the net property, plant, and equipment, and then I look at the total assets. And I do all three of those things in conjunction of how much are each of them as a component of each. So, for example, if I'm looking at a company that is, we're going to talk about some of these in a minute, but if I was looking at a company that was maybe more capital intensive, I would expect to see a higher portion of the net property, plant, and equipment or PP&E as a bigger portion of the total assets of the business. That would logically make sense. Likewise, if the company was more capital light, I would expect to see that as less. And so that can help frame maybe your expectations when you're looking at the business. The other thing is the big reason why I would look at the net PP&E or the property, plant, and equipment is because that's a huge investment that the company is making, depending on what the business model is. if you're looking at a railroad, they're obviously going to have to plunk down a couple bucks on trains and the rails and the stations and upkeeping all of those things, the systems that they use to manage the trains, where loads are going, where they're getting filled, where the trains have to go, all those things, all that stuff has to be managed. And that's where that company will spend money on those things. And you want to see them spend money on those things. If they're not upkeeping the rails, they could have accidents. If they're not upkeeping the systems, they're not being efficient and they're not delivering loads in a timely manner, which means they're costing themselves money. So you want to see those things growing, and that's where you can track a lot of this stuff. All the discussion on the AI CapEx spend, this is where this directly shows up on the company's balance sheets. When you hear all these huge numbers that Meta is throwing out, 600 billion in CapEx spend over the next 5 years, all those numbers, that's where you're going to start to see that stuff show up is in the balance sheet under net PP&E.
Yeah, perfect. Great example. All these huge data centers are net PP&E. Let's start. I wanted to start with an example. So I talked a few episodes ago about Martin Marietta Materials, one of those hidden gems that I very much like the business of. So if we were to take Dave's test, I'm pulling up their balance sheet. So these are real numbers for 2024. Net PP&E is 10 billion, and then total assets is 18 billion. So 10 out of your 18 are long-term assets. That's a capital-intensive business. What does that tell us? Again, to recap, it tells us that they need a lot of assets. They need a lot of investment in order to grow. And if that number is growing, then ideally you also see earnings growing, which has been the case for them. Now, like I mentioned a couple episodes ago, if you haven't listened to that episode, I would recommend going back and listening to it. It was our episode about light bulb moments. But what's cool is if you pull up an annual report, you can look in the notes section and they can break down some of these long-term assets and you'll get better sense for every business. Because again, the PP&E for Martin Marietta is going to be different from Walmart. It's going to be different from Meta. So in the case of Martin Marietta, they have a few that are big line items. So I'll focus on those first. So machinery and equipment. So if you know Martin Marietta, they are aggregates. They are mining the crushed stone and taking that out of the ground, turning it into the aggregates that can become concrete, asphalt, things like that. So 6 out of the 15, I'm sorry. Yeah, because there's some depreciation, so just bear with these numbers. But 6 out of the 15 is machinery and equipment. So picture, I'm not a construction guy, but like huge kind of crane things that, I can picture this stuff. If you drive by a quarry, you can see it. These big machines, you're going to need those, right? Another thing on here is mineral reserves and interests. So when a company like a Martin Marietta goes in and needs to get the government regulations in order to allow them to drill, baby drill, that gets accounted for as mineral reserves. And that's another 6 billion. So these big numbers can tell you, okay, I need to learn maybe more about their machinery and equipment, or I need to learn more about what is mineral reserves and interests. And that can be a good way to kind of go down the rabbit hole with some direction of teaching you about what the business is and what's important for the business. I noticed they doubled that number from 2023 to 2024. So that tells me that they've enhanced their long-term earning power and capacity, because that's what the reserves are. Reserves are an estimate of how much of this stuff out of the ground are we going to be able to pull up. So that tells me, okay, they are growing pretty aggressively. And then it's up to you then to take the next step. Do I agree with the growth, and do I think it's good growth or not? But that's some of the detail that you can find in the footnotes when you're looking at a business that you're familiar with.
Yeah, that's a fantastic example. Can we maybe look at maybe the opposite end of the spectrum and look at a company like NVIDIA? Do you have them pulled up? Maybe you could take a look at their capital expenditures.
Yeah, perfect. So NVIDIA, this is for 2024 calendar year. Only 6 out of 111 billion is property and equipment. If you know about NVIDIA, they don't manufacture those great, wonderful chips that everybody loves. They design it on computers and then send it off to TSMC. TSMC manufactures it for them. So actually, what's interesting is they just have like a ton of current assets. So they're just like flush with cash. They don't even know what to do with it. They have 34 billion in marketable securities. They have 8 billion in cash. They have 23 billion in accounts receivable. So they're really flush with cash, and that's something that is, I don't know. I mean, what does that tell you about NVIDIA other than the fact that they're growing like crazy? To me, it says just capital light and becoming even more capital efficient if they have all this cash and they don't know what to do with it.
Yeah, it tells you that, yeah, they are unquestionably capital light, and when you look at their financials, you would expect to see high margins for that business because they're producing such, efficient revenues. The cost of goods sold to sell what they sell doesn't cost them that much because they don't have to your point, they don't have to, they're not building the chips like TSMC is. And so you would expect to see very high margins. And when you look at the margins for that company, they are very high. And so that's, again, maybe another way that when you look at the balance sheet, it should tell you other stories about the company. You would expect to see really high margins, which you do on the income statement. Likewise, when you look at the cash flow statement, you would expect to see very high free cash flow generation and lots of efficiency in that area, and you do. And then it becomes a question of what's Jensen Huang, the CEO, going to do with all that money? And this is where his job becomes critically important. He's done all the great groundwork and of setting up the company to be uber successful, and they are. But now the big question is what does he do with all that money, and what can they do? And I mean, they have lots of choices and whatnot, but kind of going back to the balance sheet, that's how, when you do an analysis of the balance sheet, those are the things you want to look for. Like, is this a capital efficient company? Is it a capital light company? Is there a lot of assets on the balance sheet? What kind of assets are they? And it can tell you a lot about the business. All right. So maybe we could segue to Alphabet.
Sure. Yeah, let's look at Alphabet. We'll move on from PP&E for now. I reserve the right to come back to that because it's just so fun for me to talk about that. Let's talk a few other long-term assets. So non-marketable securities and Goodwill. I'm going to tackle those two. Not so, just like a company can hold cash, they can also hold bonds. We just did an episode about bonds that's coming out soon. The companies can also hold stocks, and they can also have ownership pieces of businesses. So I liked the example of Amazon. Actually, I'm going to switch to them real quick. They have non-marketable investments in their footnotes. And they said in 2023, they invested in a convertible note from Anthropic. So that's cool. They're lending money to Anthropic, which is a huge AI company, lots of potential, which is convertible. So they might get shares out of that. So high upside for Amazon on a small investment like that for them. Alphabet also has things like that in their footnotes. They also have Goodwill. So Goodwill is another big way that companies will grow. Some companies will grow through tangible assets and buildings and things like that. Some will grow by buying other businesses. Berkshire Hathaway, probably the most famous ever company that grew through acquisition. We won't get into the nitty-gritty about what Goodwill is, but it's basically that's how it's accounted for when you buy a business. You're basically absorbing the other business's assets, and then whatever that extra value is the goodwill. So, what are your thoughts on either of those?
I think they are very important to know and understand, depending on the type of business that you're talking about. To your point about Amazon, it's very important to understand that they have those equity investments on their balance sheet because that directly impacts their income statement. And when you look at a company like Amazon, sometimes you will see wild fluctuations in their earnings or their reported earnings. You'll see headlines, earnings for Amazon skyrocket or earnings for Amazon, fall off a cliff kind of thing, which are very dramatic. But if you don't understand the connection between a long-term asset that they have bought a equity share in a company on the balance sheet compared to the income statement, then you won't understand maybe why they're seeing such wild swings. I'm sorry. And Amazon in particular, with those equity investments in companies like Anthropic and Rivian, sometimes we'll see these wild swings in their equity, which means that will translate onto their income statement. And so you may see really high earnings or really low earnings, sometimes based on that, which have nothing to do with the operations of Amazon. And it can throw you off. And so it's an important thing to understand. And it's also it's important to understand this is how the business is choosing to use their cash flow as a capital expenditure or an allocation strategy. Buying a piece of Rivian for Amazon, for example, could have a bearing on that company going forward. So it could be potentially a really good investment for them because of the trucks that Rivian produces, which could help Amazon in the future. Same with Anthropic, and same idea applies with Google. Google makes acquisitions, and they also make long-term investments. And because they generate so much cash, they have lots of choices of how to divvy that up. Of course, there are reinvesting internally quite a bit, but they also will spend money on things like long-term investments and purchasing other businesses. Many people may not know that Google, some of their most popular businesses, i.e. YouTube, was not something they created out of thin air. They actually purchased the foundation of the business. They, of course, improved upon it, but they bought the foundation and the technology and have improved upon it. And so that equity investment all those years ago was now benefiting them, tremendously. So when you look at something like Goodwill, it is important to understand this is part of how a business will do this. And, I was kind of looking quickly through the other companies that Andrew was talking about before we got to Google. When you look at Martin Marietta and NVIDIA, they have very little in goodwill on their balance sheets because they are not really acquisitive companies. And so that is part of their business model. It doesn't mean they won't do it in the future, but as of today, that's not really been a big part of their business. It's not the major part of Google, but it is certainly something to keep in mind when you look at the goodwill of the business and when you look at the long-term investments. And for Google, for example, if you add those two up, it accounts for almost a quarter of maybe not, maybe about 20% or so of the total assets of the business. So it's not insignificant. So it is something to definitely take into consideration.
I found something in the footnotes I thought was kind of interesting. So they recently did a reverse acqui-hire. So we're talking about acquisitions. They did a reverse acqui-hire. I didn't even know this was a thing, but for last year, they recorded $2.7 billion in goodwill because they did a transaction with character.ai. And poking around the internet, this website, AIM Media House, talked about how the company basically hired the Character AI's founders and research team, but then didn't buy the business. But because of the accounting, you still have to treat it as if you had bought the business. It was part of a licensing deal as well. So that's kind of interesting. And then law360.com called it a regulatory gray zone. Reverse acqui-hires are a regulatory gray zone. So Kind of interesting. That is the world we live in now, where you hire people for billions of dollars because they have some AI skill. It's
Yeah.
quite extraordinary.
It is quite extraordinary. I was relating a story about, I believe it was Meta recently did something similar where they bought a business for 10, 12 billion, something in that range, simply because they wanted to hire the CEO. They
Right.
didn't, I don't think they were particularly interested in the business itself, but they wanted, the brain power that was running that company as part of Meta's AI, I guess, grand designs. And so because they probably couldn't entice the guy to leave his company, they just bought it. So
Yeah.
now he has no choice but to come work for Meta. So yeah, it's interesting, how you will see some of these things play out over time.
One of these days, we got to dig into the Braves annual report and just talk about player contracts and things like that. That might be fun.
Yeah, that would be super interesting. This kind of discussion about like buying businesses to acquire talent reminds me of baseball teams that trade for coaches. Like, I know that's not really an investment thing, but when teams trade for coaches, it just feels different. I mean,
Right.
because that's kind of what the Cubs did. They traded for Craig Counsell from the Milwaukee Brewers, and so he left the Brewers and became the coach for the Cubs, and they traded for him. They didn't trade players, they traded money, but it was because he was still under contract. That was the only way they could get him to come be the coach for the Cubs. And it's like, and I've seen that happen a few times recently, and it always strikes me as odd. But
I was not meant for this new era. I did not know that's a thing, and that's crazy. But
yeah,
good on them. I mean, he's a great coach.
Yeah, for sure. Do we want to touch on maybe how Goodwill can impact an income statement? And I'm thinking particularly in write-offs, like how that can, how that kind of like works, and maybe how that impacts a business.
Yeah, unfortunately, I know this topic intimately because it's happened with a business I've owned, or a couple. So basically, what happens is, again, we're talking about businesses buying other businesses. Not every business deal works out. And so sometimes you overpay for something. And what companies have to do as part of putting their accounting statements together is they are required to assess the different acquisitions they've made, assess the goodwill that's on their balance sheet, and decide, okay, is this asset that we thought was going to generate, $5 billion in cash flow, whatever the number is, do we now expect it to only generate $2 billion? So if that's the case, you have to take a write-off of, let's say, $3 billion, whatever the difference is for how much you thought the asset was worth to how much it's worth now. And that comes off as a charge on a company's income statement. It's in this weird kind of thing where sometimes Wall Street hates it, sometimes they don't care, and sometimes it's like they're happy because it's like we've thrown the kitchen sink at it and we're like moving forward. It's like we've gotten rid of all the dead weight on this ship, and now like financials can be clean. So the way Wall Street reacts is really weird. But what we care about as investors and long-term investors and part owners of these businesses is this is a clear-cut signal that management overpaid on a deal. And so the thing you have to think about is this just a mistake? We all make mistakes. Or is it indicative of a management team who doesn't know what they're doing? If it's just a mistake, it happens every once in a while, okay, fine. But if it's something that says, hey, they're doing this a lot, or I've lost faith in the way they allocate capital, then maybe it's a red flag to really seriously consider, do I want to still own this stock? There's all kinds of scales to it, but obviously you want to look at the numbers, and if the numbers are big, you really want to think hard about it.
Yeah, for sure. I think probably the most famous example is the AOL debacle when Yahoo bought AOL and then had to write it off. And it was, I think it was, I don't remember the exact number, but I want to say it was in the hundreds of billions. And
At least
it,
100.
it was a shock to
Yeah.
the market at the time, because that was a crazy thing to see. I haven't necessarily had this happen to a company that I own per se yet. I say yet because it's coming. You invest long enough, it will happen. And I think one of the things that I try to keep in mind is understand who it was that made the purchase and try not to hold that against. So, for example, let's say that, CEO A bought the company and made the purchase, and then they leave 3 years into the absorption or the integration of that business, and then another CEO takes over, and 3 years later they decide that this was maybe not a great decision, and they have to write it off on Goodwill and maybe sell the business or something. And you can't necessarily hold CEO B responsible for that. And so it's sometimes you just got to also try to understand who it was that made the choice. If it's company A that made the choice, company A that, or CEO A made the choice, CEO made the decision to write it off on the Goodwill, then you could start questioning the capital allocation skills. But I guess I would always try to caveat that a little bit. Maybe we can segue off the negative part and talk a little bit about maybe some potential metrics or ratios we could use with this kind of section. Do you have any thoughts on some that you have encountered or maybe used in the past?
Well, I'm all about ROIC, so I'm not a good person to ask this question. Maybe you can give us some like better metrics, like easier, simpler, tangible things like that.
I've seen a few. They aren't probably bandied about as much as something like ROIC would be. One that I've seen bandied about is comparing the change in net PP&E to the change in revenue. So, and doing it over a longer period of time, because, for example, if you're trying to assess the capital allocation of Martin Marietta, for example, when they buy a Caterpillar or they buy a big truck, that may or may not pay off as far as revenue growth immediately. And so you want to give it a longer period of time. And if you look at the change, if you can look at the change between the net PP&E and the growth in revenue, that could give you some indication that maybe the company has done a good job of allocating money to those bigger ticket items or their fixed costs, if you will. So that could be a way to kind of measure the return on that kind of investment. I've also seen people use Goodwill to assets, total assets. So comparing Goodwill to total assets. And depending on the style of business, like we've already discussed, some are more acquisitive than others. You can find decent ratios that can give you an idea of how well a company allocates its capital to buying other businesses. Remembering that Goodwill generally is the gap between perceived value and accounting value. And so, if a company is overpaying consistently, you're going to see a higher number compared to the assets, and that's not ideal. So those are two that I know that I've seen other people use as examples of ways that you can kind of measure some of these long-term assets to other parts of the balance sheet or the income statement.
Yeah, perfect. If you're going to use ROIC, go on my Twitter, I guess, and you can see the tutorials I've done, because you want to take some of the long-term assets and not all of them. You want to take the ones that are core to a business and not the ones that are not. Some other house cleaning items just kind of related to that. So deferred income tax asset is kind of like getting a tax refund for a business. So maybe they overpaid because they overestimated their tax rate, or maybe they booked some losses in the past and they're able to write some of those off in the future. That's stuff that we don't necessarily care about as investors too much most of the time. But that's just the blocking and tackling that these companies do. And you'll see that as a long-term asset. Intangible assets, also something that's related to Goodwill. You'll sometimes hear those kind of interchanged. And honestly, I think when I think of them, when I'm analyzing them, I think of intangible assets and Goodwill almost as the same. I know there's distinction behind it. I like to think of them as similar though. And then there's other assets which can encompass so many different things. Every business is different. So if it's something that you wouldn't classify for all businesses, but maybe it's special to this particular business, you might see it in other assets. One also I wanted to throw out there is operating lease assets. So this is something that was a relatively newer disclosure that happened in 2018, 2019-ish time period. Going back to the Target example, if they're opening new stores, in the past, all the stores were considered property and equipment. Now there's a distinction if a company is owning the store or renting the store, leasing the store. So those are operating lease assets and property and equipment. Sometimes for the company like Walmart, it doesn't really make much of a difference. It looks like they own most of what they have. But something like a Dick's Sporting Goods, they have more operating lease assets than property and equipment. So it does play a role. Again, like you might be able to find hidden value, little hidden gems if you're looking that deep into the weeds. One thing that I thought is kind of cool that I never hear talked about, maybe because it's just like small businesses that nobody cares about, but Texas Roadhouse has been able to essentially, I'm blanking on what it's called, but they're able to take the properties that they own and then they convert it to a lease essentially, and then it unlocks this like free cash flow for them up front. And you can see the REITs on the other side who are making those transactions, and it's been a source of revenue for them. So that's kind of fun. But that's like some of the ways that, people in the company are doing the blocking and tackling and maximizing free cash flow and all those things. So operating lease, I think, is an important one to know, just because it can tell you, does a business own its buildings or does it rent them?
And that's important to know because it has a bearing on the cash flow of the business. If they own the land, they own the building, then that is money that they've spent on those things, and obviously have to upkeep them. But if they're renting, then that's a cash flow it's a bill that they have to pay, and that has an impact on the business as well. So you have to. It's important to understand how those things connect and work, because it'll have a huge bearing on a business. You compare the retail for Walmart, or you compare the retail for somebody like a Lululemon, who I know nothing about. I suspect they probably rent, because of the nature of where their stores are. They probably rent a vast amount of their store fronts, and so that's cash they have to pay out, where Walmart does not. So obviously completely different businesses retail wise, but it's what popped into my head.
So if I were to open your closet, I wouldn't see some Lululemon right next to your, no?
No. I am fashion challenged. That is for sure. My wife complains about it incessantly.
Any other thoughts on long-term assets? Definitely, we threw a lot out there. I would say pulling up a balance sheet and just trying to become familiar with one or two. Pick a company that you like. I think could be a great way to start to wrap your head around some of these concepts. What do you think?
I think the balance sheet probably is underrated in its ability to tell you quite a bit about the business without looking at the other two main financial statements. And the GOAT Warren Buffett said in his last annual meeting that he spends more time looking at the balance sheet than he does any of the other financial statements. And your immediate reaction might be, well, yeah, he invests in like these capital intensive businesses, insurance and things like that. So it makes sense that he likes to look at that. But I would argue that the balance sheet, even in today's air quote capital light world that we think we're living in, there's still a lot of value that you can derive from looking at the balance sheet, even of a company like NVIDIA compared to a more capital intensive company like Taiwan Semiconductor. You can learn a lot from about both companies from the balance sheet. So I would encourage people to, as Andrew said, pick a few and start just kind of analyzing them, looking at them, understanding the line items, understanding what these numbers are telling you about the business model, and also what they're telling you about the potential growth for the business. Because remember, without these assets that we're talking about, none of these companies can grow. So they need these assets to be able to grow. And so it's important to understand.
Yeah, totally.
All right. Well, with that, we will go ahead and wrap up this edition of Financials Demystified. See, I told you it wasn't going to be boring. And with that, we will go ahead and wrap us up. You guys go out there and invest with a margin of safety. Emphasis on the safety. Have a great week, and we'll talk to you all next week.
We hope you enjoyed this content. 7 Steps to Understanding the Stock Market shows you precisely how to break down the numbers in an engaging and readable way with real-life examples. Get access today at stockmarketpdf.com. Until next time, have a prosperous day. The information contained is for general information and educational purposes only. It is not intended for a substitute for legal, commercial, and/or financial advice from a licensed professional. Review our full disclaimer at einvestingforbeginners.com.